All right, Mr. Baldev Prakash, Managing Director and CEO of J&K Bank now joins us. Now, Mr. Prakash, good morning. Thank you for joining us. First, can you share with us the big picture in terms of where, to your mind, the credit cycle for FY23 and beyond is headed? Because last couple of months have been extremely lucrative for the entire banking sector per se. Do you think the party is here to stay?
Good morning, Nikunj. Good morning, and thank you for having me on your show. So, as you might have observed that due to continuous interest rate hikes, there has been some moderation in the credit demand in the last quarter, that is Q4. But if you see the RBI statistics for up to December 2022, the credit demand has been good, and it was ranging between 17 to 18% YOY. And in the latest weekly supplement, it has come down to about 15% YOY. I think at the start of the year for our bank, we have given a market guidance of 15% credit growth in J&K and 20% in rest of India. Because rest of India, we want to improve our book because the share of this book had come down below 30%. So, and I believe we shall be ending the year in the range of 15%, and that is very much on the expected lines.
And you're saying this 15% is going to be sustainable for the next 2 to 3 years as well, right? 15 to 20% range of credit growth?
Yeah, so for us, this year has been a major thrust area for strengthening of our balance sheet. That is by way of capital augmentation and reduction in the stress assets. And I'm happy to tell you that we have achieved the both. So we are expecting to end the year with the capital adequacy of around 15% and gross NPA of 6%. So on the back of this strong balance sheet and adequate capital growth capital, we anticipate a credit growth of mid-teens, 14-15% in the next year, 23-24.
Asset quality though, what is the risk that you think you're taking on your incremental book?
As of now, I think that the credit quality which has come, the gross NPA which has come from 9.67% to 6% now, I think this will continue improving this year also. And we are expecting that this will support our overall improvement in the balance sheet also, as well as in the going forward, there's hardly any delinquency in the slippages are under control.
So the latest amendment with respect to the debt mutual fund is expected to support the shoring up of deposits as well. How's been the growth for you when it comes to deposits, and what trend you are expecting there?
Yes, so the latest amendment, I think it is too early to say that it will have a major impact on our balance sheet, our deposits. Yes, as you see that the CASA has been a big strength for our bank, which will continue to be above 50%, which we expect. And for J&K, I think because our liabilities franchise is mainly relating to J&K and Ladakh, we don't foresee much impact as of now.
That's the take coming in as far as deposits is concerned. But your NIMs are at 4.1% the last time I checked. Given the fact there is going to be pressure with respect to the cost of funds, plus the deposit rate, etc., is going to be higher, do you see a pressure on NIMs going forward? Will it be, let's say, less than 4% or at least hold on to 4% mark?
So owing to the good franchise for liabilities, I think the CASA of our bank has been above 50%. The bank has maintained this net interest margin of 3.5% for quite a long time. And yes, in the quarter 2 and quarter 3, there has been an uptick in NIM that was above 4%. And we are expecting to end this year with NIM very close to 4%, which would be better than what we envisaged during the start of the year. Yes, rising interest rates will have some impact on the NIM. But given that we have registered a quite good improvement in our assets quality, so we are expecting that NIM should be in the range of around 3.75% for our bank.
How much of your business currently is coming from non-J&K? Because for J&K Bank, that in a sense was an advantage when others were not allowed to open branches there. Then that also became a disadvantage.
Yes. So as of now, the major liability franchise is coming from J&K, and in advances we have rest of India. 30% book is from rest of India, and 15% of this liabilities are from rest of India. The rest is from our home territory of J&K and Ladakh.
How exactly are you looking at building your liability franchise? Because you do have an advantage in J&K, but outside J&K that advantage may not be there. And only having a great branch network in J&K may not give you so much of liabilities.
Yes. So yes, for rest of India, as of now, we have a presence in 17 states and 2 union territories with 127 branches. For rest of India, we are looking to expand in selective areas, markets, so that to augment our pan-India presence. And this expansion will be based on the feasibility and viability, which will support our liability franchise.
The take coming in as far as what the outlook is, you've guided for a bit of a negative sentiment. I mean, not that you have guided, but there's a bit of a negative sentiment around the 81 bonds at this point of time. It was Yes Bank, and then globally there is what's happening with Credit Suisse as well. What's your take as to what the cost pressures could be regard to raising liability, especially with 81 bonds now? Do you expect the cost to go materially higher for 81 bonds?
Yes, in our case, for this year, we were able to raise Tier 2 capital of 1,021 crore, and we had the approval of 1,500 crores. So maybe in Tier 2, we can think of increasing further, but that will be happening only we have a rating upgrade, which we expect during the Q1. So 81 bond, we have not yet ventured. And yes, for stock capital, for equity capital, we have raised 300 crores, about 300 crore during this year through employee stock purchase scheme. And we have a good internal accruals also, and with a good capital adequacy ratio, which will be in the range of 15%. I think we should be able to have a good capital for our growth, and we don't foresee any challenge as of now.
Going to raise equity at least in FY24.
Yeah, so FY23-24, we are expecting, as I told, that we are expecting an upgrade in our rating. So with that support, I think we should be able to raise capital in 23-24. And above all, we have a good internal accruals also that will also continue supporting our capital adequacy ratio.
Looking to raise if indeed the rating uptick comes in?
Yes, we expect that, because a lot of improvement in all parameters you might have observed in the bank in the last 1 year. And we expect that should happen, that the rating upgrade must happen now.
Right. I just wanted to understand how much money are you looking to raise when the rating upgrades come in?
So we had the approval of 1,500 crores, as I told, and we raised 1,021 crores. So the remaining amount we will raise in Tier 2. And in Tier 1, we had the approval of 500 crores, 300 we have raised. So maybe another 200 crores we will be able to raise. But for that, for capital raising on the equity front, it will depend upon the credit growth momentum, the market sentiments, price to book multiple, because we are not looking to dilute at a level below our intrinsic value.
Right. Okay, Mr. Prakash, great to have you on the show today. Thank you so much for taking the time out.
Thank you, ma'am.